Okay, we should not equally forget that we started our lecture from cost estimation, to marginal costing, from marginal costing now to absorption costing. Please, for those who are just joining us for the first time, you can go to the playlist, PM playlist, and check the courses, the topics that we have done so far. Please, before we continue with our lecture today, do we have anyone that have question based on what we did in our previous class? If you have question, quickly unmute your mic. If you have question, you can unmute your mic before we continue today's class. Do we have any new member that are just joining us for the first time? If you are joining us for the first time, please can you quickly unmute your mic? Just raise up your hand, unmute your mic and introduce your name and your location.
Okay.
Good evening, sir.
Good evening.
My name is Kelechi from Lagos.
Okay, Kelechi, you're welcome.
Thank you, sir.
Good evening, sir.
Good evening.
Good evening.
My name is Destiny from Port Harcourt.
Okay, you're welcome, Destiny.
Good evening, sir.
Okay.
Good evening, sir.
Good evening.
Good
My
evening,
name is
sir.
Kenny from Lagos.
My name is
Okay, you're
Joyce from
welcome.
Port Harcourt.
Okay, you're welcome, Joyce.
Yeah, good evening, sir.
Thank you.
Yeah, my
Good
name
evening.
is from Lagos.
Okay, you're welcome.
Good evening, sir.
Good evening.
My name is Francis from Abia State.
Okay, you're welcome.
Good evening, sir.
Good
My name is
evening.
Kate from Ibadan.
Ibadan, you're welcome. So, you're welcome to, okay, good evening, Sonia. Okay, go ahead.
Sonia from Akure.
Okay, from Akure, you're welcome. My name is Ibrahim Akindele from Federal Capital Territory, FCT. So you're all welcome to Next Gen Professional Associates, right? You're welcome. So we shall continue our lecture. We started from marginal costing. Now is absorption costing. The question is, what is absorption costing? We should not forget that marginal costing is a costing technique that value its inventory using the variable cost and charge all other costs as period cost. Period cost is fixed cost. Kenny, can you mute your mic? Can you off your video, sorry? I think someone want to present. Interesting. Okay, let me quickly remove it on there. Okay, that's fine. Could be a mistake, right? Share screen. Okay. Maybe the person want to teach us. I don't know. I think the person is. Should I mention? Should I call the person's name? No. Interesting.
It was a mistake. Oh, it was a mistake.
Yeah,
Yeah.
that's fine. I know. That's fine. That's fine. So we should not forget that the marginal costing is a costing technique that value its inventory using the variable costs per unit and charge all other costs as a period cost. Another name, the period cost is fixed cost. Now, this is an absorption cost. Please mute your mic. You are violating the rule. We'll see. Right. Okay. Now, absorption costing is a costing technique. You can call it a conventional or traditional techniques that charge all costs, both variable costs and fixed costs, into a particular production class. It is also known as a full cost. Marginal costing is usually a traditional techniques or conventional. When you say traditional approach, when you see a traditional, they say, okay, calculate this using a traditional approach. Traditional approach is a marginal is an absorption costing, which charge all costs, both variable costs and fixed costs to operations. Meaning that when you want to value inventory under the absorption costing, you use full cost. And what are the full costs? What are the full costs? The variable cost per unit and the fixed cost per unit, right? The variable cost per unit and the fixed cost per unit. So absorption costing value its inventory using the full cost. Absorption costing is also known as conventional or the traditional approach class. Now, having explained this, we can say absorption costing could use percentage of direct material costs.
Sorry, sir, we can't see your screen.
We or you?
We.
Me too, I can't see the screen.
The screen is visible. Maybe you should log out and log in again.
Exactly.
Okay, I can see the screen.
That's fine. Now, the absorption costing could use percentage of direct material costs, percentage of direct labor costs, or percentage of prime costs, the unit produced, machine hours, right, for determining the overhead absorption rate, depend on the circumstances of a particular situation. Class, the question now is, what is overhead absorption rate? We will get there. Now, my point here is that absorption means consumption. When you want to absorb an overhead, An overhead could be absorbed. An overhead could be absorbed on the basis of machine hours, percentage of direct material, percentage of direct labor. It depends on what is given to you in the question, class. You'll be, as we move, we'll talk more about overhead absorption rates. Class, absorption rates, right? Absorption, you can absorb an overhead using the different bases. Either depends on what is given to you in the question. The question may tell you that the company absorbed their overhead on the basis of machine hour. You know that you are allocating your cost based on the machine hours, based on the numbers of machine hours. If the question says, oh, the basis of absorption is based on the unit produced, you know that you are allocating your costs based on the numbers of units you produce. If the question says that it is based on machine hour or labor hours, it is based on the numbers of hours worked. The question now is, what is overhead? Now, overhead are costs that are not incurred directly into a particular production. They cannot be traceable. You cannot use them directly when producing it. An example of an overhead cost, you can call it, is an indirect cost. An example of an overhead cost is rent. You pay rent. Now, let's say you are producing cement. You pay rent. That rent, you cannot charge it directly into a particular production. That rent is just like a service. You need it. It is unavoidable cost because you can't do without the rent unless you want to shut down the operation. So overhead is a cost that cannot be traceable. It is unavoidable cost. You can avoid it if you want to shut down the operation. Class. Now, what make up the overhead cost? Indirect material, indirect labor, indirect expenses is equals to the overhead cost. Any cost that cannot be used directly into a production. Now, we have a direct expenses or direct cost. The material you use, it is directly into a production because you must use material to produce. Labor, once you use labor to produce, these are direct, but indirect, it is like a service. Let's say, for instance, supervisors will just come. They won't even do anything in the product. They'll just come and look at what you are doing. Okay, that's fine. You are doing well. There we go. It is an indirect cost because you did not incur it directly into the what? Into the production. It is just like a service. So what I'm trying to explain here is overhead costs are costs that cannot be traceable. Class, company may absorb their overhead on different bases. They can tell you that overhead, okay, how do we want to apportion our overhead? We can do our overhead on the basis of either the numbers of units. If they say apportionment or absorption, absorption means cost. Let's say, for instance, you have rent of 50,000. Then you cannot say that, okay, this rent of 50,000, how much will it now cost us? Let's say you are now producing 50 units. How much is the cost per unit? Class, how much is the cost per unit? That is, on that basis, you want to know your overhead cost per unit. You want to know what is the rate of consumption of that overhead based on the numbers of units that you actually produce. That is why they say it is an overhead absorption. Absorption means you want to know what you consume. Class, am I communicating, please? Am I communicating?
Yes, sir.
Yes, sir.
Okay.
Yes, sir.
Now, I want to explain this. We move to absorption of overhead. we move to absorption of overhead. Don't forget that I've actually defined absorption costing, overhead, right? And overhead can be absorbed on different bases, either machine hours, either the unit produced, percentage of prime cost, labor hours, or machine hours, depends. Now, the question is absorption of overhead. Now, absorption of overhead is the process. Now, more explanation on it now. Absorption of overhead is the process where the overhead costs allocated and apportioned to production cost center, class. Just what I just explained now. So production cost center are added to the what? To the unit, class. Absorption costing means absorption of overhead means that this cost cannot be traceable. Now, we want to now apportion it to a particular production unit. You may apportion it to production unit. That is, you want to know the cost per this overhead. You want to know the cost per this overhead. You want to know it. It could be either unit produced. Depends on what is given to you in the question. It depends on the company policy. The company policy may be that they absorb their overhead on the basis of machine hours or unit what or unit produced. Now, overhead absorption is sometimes called overhead recovery, right? Overhead what? Recovery. You know the reason why it is called overhead recovery as we move. Now, this is done using a predetermined overhead absorption rate. Class, this is done using what? A predetermined overhead absorption rate, which means that when you want to determine your overhead absorption, overhead absorption, you want to know the numbers of units, you want to know the cost per unit that you consumed, right? Another name for this overhead absorption is called predetermined overhead absorption rate or predetermined rates. Class, it is called what? Predetermined overhead absorption rate. Class, you want to know the numbers of units you consumed, right? You use your overhead absorption. And this overhead absorption, when you want to calculate this overhead absorption, you use it is usually predetermined overhead absorption. Either you call it overhead absorption rate or you say predetermined overhead absorption rate, right? Calculated from the budgeted. Of course, all your overhead costs, it is based on the budgeted, right? You know, overhead costs are costs that cannot be traceable, right? They are more or less like a fixed cost, right? So a fixed cost does not change according to what you produce. No, a fixed cost is based on your budgeted. Class, the reason why a predetermined rate is to avoid the delay and fluctuation that will arise if actual figure. Now, how do we determine the overhead absorption rate? We should not equally forget that overhead absorption rate is also known as predetermined overhead absorption rate. Now, the question is, how do we now determine this rate? Class, how do we determine the overhead absorption what? The overhead absorption rate. How do we determine this overhead absorption rate? Now, we should not forget that I explained absorption costing. It's a costing technique, it's a traditional techniques or conventional techniques, right? Traditional or conventional techniques that charge both variable cost per unit and fixed cost per unit for production. That is full cost. It deals with full cost. Unlike marginal costing, that is only variable cost, that charge only variable cost. Class. Then I equally explain the absorption. Of course, when you need to, I actually explain overhead, that overhead are costs that cannot be traceable. Now, the question is, how do we absorb our overhead? Absorption means consumption. You want to know the rate per consumption. That is why we have overhead absorption rate. You want to know the rate per consumption. You use overhead absorption rate. Another name for our overhead absorption rate is also known as what? Predetermined overhead absorption rate. Now, when you want to absorb overhead, absorption of overhead is based on the company policy. The company policy may state that it is based on unit produced. Use it, calculate your overhead absorption rate based on the unit produced. If the company policy says that the overhead absorption rate should be calculated on the basis of, or the fixed overhead should be calculated on the basis of machine hour or labor hours. Calculate the overhead absorption rate on the basis of that machine hours. It could be calculated at maybe percentage of prime cost, labor hours, machine, but it depends on the company policy. Now, how do we determine this overhead absorption rate? Overhead absorption rate means that cost per one. That is overhead absorption rate. Absorption means consumption. Overhead means cost that cannot be traceable. Absorption means consumption. Rate means per one. You want to determine the cost per one. So if you want to determine the cost per one, it may be on the basis of machine hour or labor hours. It depends on the company policy. Now the question is, how do we determine overhead absorption rate? First, identify the budgeted overhead for the period. Class, if you want to determine the overhead absorption rates, class, if you want to determine the overhead absorption rates, first, identify the budgeted. Okay, is even here actually. So identify the budgeted overhead for the period. That is the fixed overhead. What did you budget for the period? At the beginning of January, every organization will say, oh, we budgeted 60,000 naira. We want to spend 60,000 naira for the year 2025. That is budgeted overhead. That is their cost. Right? Now, identify the budgeted levels of activity. Now, the budgeted levels of activity now could be machine hours, could be unit produced, could be labor or machine, could be percentage of prime cost, right? Now, determine the overhead absorption rate. You want to determine the OAR, overhead per one, that is cost per one. It will now be what? The budgeted overhead that you've identified, which is the fixed overhead or the fixed cost or budgeted fixed overhead, anyone, divided by the what? The budgeted level of what? Divided by the budgeted level of activity. The budgeted level of activity could be machine hours, labor hours, or unit, depends on the company policy. Now, you will see how we use that to multiply as we move on. So the main thing is that you should know how to determine your overhead absorption rate, which is calculated as budgeted overhead or budgeted fixed overhead divided by the budgeted levels of activity. Now, basis of assumption, I've explained this in my explanation that you can absorb an overhead on different bases, either percentage of material, maybe labor, machine hour, or unit produced, depend on the company policy, depends on what is given to you in the question. In the question, we stated that, oh, the company absorbed their overhead on the basis of machine hour, or the company absorbed their overhead on the basis of labor hour. All you need to do is that get your budgeted, identify the budgeted overhead or the fixed overhead, divide it by the levels of activity, which the budgeted levels of activity could be unit produced, could be budgeted levels of activity. Sorry, budgeted levels of activity could be budgeted what they actually budgeted for. It could be based on machine hours or labor hours. We'll get there. Now, OAR now. Can you see overhead absorption rate? I still actually repeat it. I repeated it here again so that you will see it. OAR means overhead absorption rate. If you don't want to call it overhead absorption rate, you can say predetermined rate. If you don't want to call it predetermined rate, it's also known as fixed cost per unit. Class. It is also known as what? Fixed cost per unit. Class. It is also known as what? Fixed cost per unit, and it is calculated as, can you see it? Budgeted, fixed overhead, divided by the what? Budgeted levels of activities. What they actually budgeted for that they will produce. That is budgeted level of activities. Class, budgeted fixed overhead or fixed overhead divided by the budgeted levels of activities will give you your OAR. What you say you will produce. It may be unit produced. It could be machine hours. Depends on it. They may say that, okay, they want to work for 150 hours for this year. It is budgeted levels of activity, right? And it is what it is. So this is the formula for calculating OAR. Class, are we still together, please? Are we still together? Who is against me in
Yes,
this?
sir.
Yes, sir.
Yes,
Okay.
sir, we did that.
Okay, that's fine. So who is against me in this class? Who is against me? We are together, right? We are together. Okay, that's fine. So I need to ask. Now, how do we determine? Another thing you need to know under why do we have to understand this? It is very important because under the absorption costing, you need to understand what is overhead. You need to understand how to calculate your overhead absorption rate. That is why I have to explain it one after the other before we go to the format, right? Now, overhead and absorption rates, overhead and over and under absorption of overhead. This is usually the main problem, right? When it comes to absorption costing, right? Over, under. The other person will say, it is over. The other person will say, it is under. Now, listen, please pay attention. Overhead absorption occurs when the absorbed overhead is greater than the actual overhead. Class, when the what? Class, you cannot compare Abigail, that she's in this class, and Abidemi. Both of them are in this class. You cannot compare Abigail and Abidemi. They must have something in common that you will say, Abidemi, she is tall. Then the other one, she is not. You know, they must have something in common. Maybe Abigail too. She's actually, you know, it depends, right? So what I'm trying to explain is that you cannot compare Akindele family with Titi family, for instance, because they must have something in common before you can say, oh, you want to do a comparison. You just like you want to compare, and let me don't use politicians. Let me say you want to compare, you know, when you want to compare someone with one another, you know, they must have something in common that you will use that, okay, this person has this person did not have this, right? Now, what I'm trying to explain this is because you need to understand that if you want to have your over-absorption occurs when the absorbed overhead is greater than the actual overhead. You understand better. Why under-absorption occurs when the absorbed overhead is lower than the actual overhead. Class, this is just maybe theoretical explanation, right? Now, over/under absorption arises because actual overhead cost is different from budgeted overhead cost. Now, let's pick it up from there. If you want to determine your over and under absorption, like I said, you will appreciate this when we get to variance analysis. Now, over and under absorption, if there is difference between your actual overhead and the budgeted overhead, if there is difference between your actual overhead and budgeted overhead, so you can either have over or under absorption. Let's say a practical illustration. You have 3-bedroom flat. Let's say you have 3-bedroom flat of let's say about 3 units or 6 units. they bring NEPA bill. When they bring the NEPA bill, they now say, oh, Sonia or Abigail, we have to divide it into 6. We divide it by 6 so that we divide it equally. Then the question Abigail will now ask is that is cheating, because the consumption, the rate of consumption I'm using will be different from the one you are using, right? Is that not so? The rate of consumption that I'm using will be different from the one that you are using. Is that not so? Now we'll get to that point of activity-based cost. Now, what I'm trying to explain here is you budgeted for something, and there are two different things. You have your actual cost. There are two different things here, right? Your actual cost and your budgeted, right? If it is different, you can have what we call over or under absorption. Now, over absorption simply means that the cost account. Okay, let me quickly move to the treatment. How do we treat this over absorption? Over means you have overcharged something. Now, over absorption simply means that the cost account have been overcharged. When you overcharge me for what I don't consume, you overcharge me. I did not consume it, but you overcharge me. That is over absorption. Why under absorption implies that the account have been what? Undercharged, right? You that you consume more, they will undercharge you. Me that I did not consume, they overcharge me. That is why we have overcharged and under. Now, how do we treat over absorption? Over absorption means that they overcharge you, right? Now, over absorption is a gain and should be added to the gross profit. When you have an over absorption, don't forget that from my notes, over absorption occur, over and under absorption occur if arises if there is difference between the actual overhead and the budgeted overhead. Definitely you will have either it is over or under absorption class. Now, how do we treat the over? Over means I have overcharged you. Like a practical illustration, we have 3-bedroom flat or 6 units. They bring a NEPA bill of 50,000. I mean, we say, oh, we have to share it equally. Let's share it, divided by 6. Now, if I'm just using, maybe if I don't even have television, if I don't have anything that has to do with electronics in my house, you are overcharging me. You are overcharging me. Is that not so? You are overcharging me. And someone that uses maybe water heater, use all the electrical appliances, right? And they gave him the same fee that I paid. Can you see that you are overcharging me and you are undercharging the person, which is not supposed to be like that? And that is the reason why activity-based costing now came into existence. Now say that no, enough is enough. You cannot be overcharging me for what I don't consume, right? We'll get there. Activity-based costing. That is the reason why activity-based costing now came into existence, to replace the traditional approach. No. It is not done anywhere that what I don't consume, you charge me what I don't consume, right? So we'll get there. Activity-based costing. Now, my point here is that if you have over absorption, it is a gain. Do you know why? Because it's a over absorption is a gain and should be added to the gross profit, right? You will still know the reason why it is a gain, and you will be looking at it that over absorption is supposed to be expenses. No, class. No, over absorption is gain. You will know the reason why it is gain as we move. Now, or deducted from the cost of sales. Why under absorption? When you have under absorption is a loss that should be what added back to the cost of sales. We will get there from the. So now students should endeavor to ensure that they are consistent with the method chosen as this has been found to be a source of worry to many students. Of course, the treatment of overabsorption and underabsorption has become a major bottleneck for students. But in this class, I'm going to explain in practical illustration whereby you will know that, yes, this is overabsorption is a gain, and underabsorption, it is actually what? Loss, which will be what? Deducted, which will be added to the what? To the expenses. We'll get there. Now, we have the advantages of absorption costing and disadvantages of absorption costing, right? So you can read up the advantages and disadvantages of absorption costing, where we have the difference between the marginal costing and absorption costing. We should not forget that marginal costing value its inventory using the what? The variable cost. Marginal costing decision is on contribution. Is that not so? Absorption costing charge is a costing techniques which charge all both fixed costs and variable costs per unit into a particular production. It absorbed it into a particular production. Why marginal costing, right? It is only for what? It is only for short-term what? Decision class. So these are the two different because of differences in the valuation of inventory as well as what? The decision. Marginal costing decision is based on contribution. Absorption costing decision is not based on what? It is not based on contribution. Now we have the format here. I'm supposed to extract this format. We're supposed to prepare this format from scratch, right? Just like the way we did our marginal costing, but permit me to use this format. Class, are we good? Class. So please permit. Okay, please permit me to use this so that we'll not waste much of our time, right? It is still, sir.
I say it's all right, sir.
Okay, thank you. So it is still the process. It is still there are some changes there, right? You know, we did absorption costing from scratch. Now, absorption costing, marginal costing from scratch. Now, absorption costing, we should not forget that absorption costing is a traditional costing approach or conventional. When you hear conventional or traditional, you should know something should come to your mind is what should come to your mind is it should be what? It is what? Absorption costing. And absorption costing have different bases of absorption of overhead. Maybe on the basis of material, budgeted unit produced, budgeted machine hours, or labor hours. It depends on the company policy. These are what you should watch out in your question, right? Now, how do we determine the overhead absorption rate, right? OAR. Budgeted fixed overhead divided by the budgeted level of activity. Now, we have over or under absorption. Over means gain. I've overcharged you. Gain. Class, you are to produce 50,000 units. Budgeted. Then you now produce 100,000 units. You now produce 100,000 units. What do you have? You have overproduced. Is that not so? You have overproduced. That additional that you overproduce, it is a gain to you. Is that not so? Don't worry, you still understand all these things. So over means gain. Under means what? Loss. Now, this is the format. Just like the way we did marginal costing. Now, maybe you have selling price per one. I assume we have year one and year two. Selling price, let's quickly run through the year one first. The selling price per unit times the sales per unit, right? Times the sales per unit times the sales per unit. Now, you know, in marginal costing, you have variable production costs. Absorption costing is just like your normal profit or loss. Just picture absorption costing as your normal profit or loss. Marginal costing decision is based on contribution. Absorption costing is like the normal profit or loss because the format is in line with the standard. Class, the format is in line with the what? With the standard. It is actually allowed for tax purposes. Class, you cannot present marginal costing for tax purposes. Now you go to you go to the relevant tax authority. Then when you have contribution, they will ask you question: what is contribution? What is contribution? Right now, absorption costing is in line with the what? With the standard. So it is actually allowed for tax. So picture it. Picture absorption costing format like your normal profit or loss, like your normal IS1 profit or loss income statement. Now we have the cost of sales. Yeah. Then opening inventory. Class. Sometimes if opening inventory of, we should not forget that the closing inventory of December is opening inventory of January. Class. The closing inventory actually illustrates the step-by-step approach to determine opening and closing inventory. For those who are just joining us for the first time, you can go to the playlist, check marginal costing. You will see how to determine opening inventory as well as what? The closing inventory. Now, the question now is, you've determined your opening inventory. Sometimes it may not be given. Is that not so? Oh, that reminds me, I gave assignments. How many of you attempt the assignment? I gave assignment on this. Yes, I remember. Hello, are we still together? Hello, I gave assignments now. How many of you attempt the assignment?
Sorry, it's like I'm not hearing alone again. Am I the only one or the network for everybody?
So I
You
think
are
I
not the
think
only
it's
one.
everybody.
All right, thank you.
Hello. Yeah, my network. Please confirm. Can you hear me?
Yes, sir.
Uh, Network, oh, that's fine. I'm back. Okay, please, if you know you attended the assignment, thank you. Please, the question, please share your suggested solution in the to the general platform, right? So I will see it there. So please, if you are here to attempt that question, please attempt it. It's very important, please. Now, how do we value the inventory here?
Sorry, sorry, sir. I was lost. What is the question again, sir? So that I'll be able to attempt it, please.
Were you in class?
Yes, I was in the last class, yes. Yes, sir.
I give assignments now.
Or you can, or I can't remember, or maybe after the lecture today, you can still help us to drop the question.
No, I can't drop the question. Have you paid for the material? If you pay for the material, you will see it. If you pay for the material, you will see it in your drive.
Okay.
So just take question 3.
Okay, I'll pay for it. All right. Thank you.
That's welcome. So Fei, I think I saw your suggested solution, right? Is it Fei? I think I saw someone suggested solution, right? That's fine. That's fine. Okay, so the formats. Okay, now the question is, oh wow. Okay, that's fine. Now, how do we value the inventory using absorption costing? It is full cost, class, full cost. Full cost means variable cost per unit plus fixed cost per unit, then multiply by the unit of the inventory. We give you the value of the opening inventory. Why should we have to use do we have to use full cost? Because it is absorption costing. It deals with what? Full costs. So when you determine your opening and your closing inventory, what you will use to multiply that unit, it is full cost per unit. Now, how do we determine the full cost per unit? This will take us to another steps, right? Okay. Determination of full cost per unit, step 1. Class, am I too fast? Am I too fast? Hello, class.
Hello, sir. We are okay.
Okay.
I think you're too fast.
Okay, that's fine. Determination of full cost. How full cost per unit? How do we determine? The person to meet is our mic now. Is that Steven? So how do we determine the full cost that we use to value the inventory? Right? Direct material cost per unit, direct labor cost per unit, variable production overhead cost per unit, fixed cost per unit. Your fixed cost per unit is your OAR, which is your overhead absorption rate. Class, your fixed cost per unit is OAR. When you add everything together, it will give you full cost per unit. Did you see variable selling here? Variable selling is not part of production at all. Whether non-production, it is not. You will not use it to determine full cost. That is why we have here the variable production, right? The variable production direct labor. Variable selling is for sales class. You don't include it as part of, I've mentioned it in our previous class, please. You can go, you can check marginal costing again. Visit that marginal costing again. Now, if you add everything together, you will have full cost. So this full cost, you will now multiply it by the unit of opening inventory. We now give you the what? The value of your opening inventory. If at all, if you have value, if you have opening inventory, fine. Now, what's next? Now, the question is, before we move to the other part of production, before we move, how do we determine the fixed cost per unit or OAR? This will now take us to step 2. If you want to determine the OAR or fixed cost per unit, it is calculated as the budgeted fixed production overhead. I've mentioned it before now, right? Divided by the budgeted level of activity. The budgeted levels of activity could be labor hours, machine hour, or it depends on the company policy. The question may say that, oh, the company absorbed this fixed overhead on the basis of units produced. It means that on the basis of the unit budgeted level of activity. Now, or labor hours or machine hours. It depends. Class. Now, if you calculate your OAR, you put it here, then you add it together, it will give you your full cost. That is step 2. Now we move. Now, you should not forget that in your income statement, you have opening inventory, add purchases, less closing inventories, and also. Now, your production cost is like your purchase. Do you know why? Because you will buy inventory, you will buy material. Is that also? Labor, you will pay labor. Is that also production? Into production. Those guys who are into production, that is your production. Is that also? Now, what I'm trying to explain here is that you want to produce 50,000 units. What will it take you to produce that 50,000 units? Class, the cost that will take you to produce that 50,000 units, you will need material. Class, is that not so? You will need labor. Is that not so? Is it not production cost? It is a production cost. That is why I said production cost. Now, production cost is now calculated as useful cost per unit. Don't forget, this is absorption costing. It is full costs. Useful cost per unit times the unit what? The unit produced. We give you the production. Production cost is your addition of both the one you incur directly and the one you did not incur directly. Because without the rent, without you having a place for that production, can you produce it? No. So use the full cost because this is absorption costing. It charges all the whole cost to production. Now, times the unit what? The unit produced. That is why it is called production cost. That is your opening inventory, add your purchases. Now, replaces production cost. Now, less closing inventory. Your opening inventory, add purchases, less closing inventory. Is that also class? Am I communicating, please? Am I communicating? Thank you.
Yes.
Now, how do we determine? We should not forget, please, go back and check how we determine opening inventory. Should I show you again? And closing inventory under the marginal costing. It is still the same thing. Determination of opening and closing inventory. Can you see it? Let's go back to the marginal and absorption costing. Now, the same way, how do we value it? We are still in year 1. We are assuming it is for 2 years. The question is, how do we value the closing inventory? The closing inventory too will still be valued at full costs. Full cost, your variable cost per unit. That your variable cost per unit, it excludes variable selling, because variable selling is for sales. Class. The variable cost per unit, that is the full cost. Variable cost per unit plus the fixed cost per unit. The fixed cost per unit is the OAR. Then multiply by the what? By the inventory. Now, when you multiply, you will have the value of closing inventory. Class. If you have the value of closing inventory, you had your opening inventory, you had your production cost, you less this. You have this, you have your cost of sales. This is your cost of sales, right? You deduct it from this, from your sales. You have gross profits. Then add other income. Now, you move to, let me just pause from here. Let me pause here. Let's pause. Now, you move to the next year, maybe year 2. Maybe you are given 2 years. Class. The selling price of year 1 may be different from year 2. Depends. The sales unit of year 1 may be different from year 2, according to the question. Is that not so? Now, you still multiply times the sales unit. Class. What will be your opening inventory? Just take, you should not forget what we did in our previous class under marginal costing. Just take your closing inventory of year 1. Your closing inventory of year 1 will be opening inventory here. Just pick, this is the closing inventory for year 1. Just pick the value here, put it here. Will be your opening inventory. Then you do the same thing, production cost, use full cost. Is that not so? Now, what they produce in year 1 may be different from what they produce in year 2. Class, in some cases, this full cost, you may have separate full cost for year 1 and year 2. Fine. In some cases, you may just have only just this full cost. You will use it for your full cost per unit. You will use it for year 1 and year 2. But your production, what they produce, may be different, right? Let's say the full cost for year 2, full cost per unit, year 2 is 2 naira per unit, times maybe they produce, probably they produce 20. They may actually produce 10 in year 1, depends, right? So you may have different full costs. You may have the same full cost per unit. It depends on what is given to you in the question. That is why I say you should attempt that question 3. Now, I want to explain this. Your closing inventory, of course, if the closing inventory for year 2 is 20 units, you need to multiply this 20 units times the full cost. If you are given the full cost, if you are given separate costs from year 1 and year 2, maybe direct material, maybe 2 naira for year 1, direct material, 3 naira for year 2, separate unit cost. Please get the full cost, multiply it by the unit, by the closing inventory, so that you can have the value, of what? The value of closing inventory. Multiply this by the full cost, which is your variable cost per unit, which is your direct material, your direct labor, as well as your overhead cost per unit, right? And your overhead cost per what? Per unit. So if you have this, you deduct it, you have this, you deduct it from your sales, you have your closing inventory. Before I continue from here, do you have anyone that have question? Before I move to other income, before I say, oh, add other income after the gross profit. Do you have anyone that have question? If you have question, quickly unmute your mic. If you can't see my screen, it's your network. Oh. I think it's your network, actually. Please, are we good? Can I move on? Okay, let me just finish so that you ask your question. Okay. Now, if you look at this, we should not forget in our income statement, if you have gross profits, right? If you have gross profit, you had back. If you have gross profit, you had your other income to your gross profit. Now, this will now take us to over absorption and under absorption. Over absorption means that they have overcharged you. You have overproduced that product. Then that additional unit you are overproducing, it will become gain to you. That is why over absorption is added to the gross profit as income. Why under absorption will be part of the expenses. That is, we tell you that produce this, so we have already budgeted for 20,000 naira. Make sure you produce 10 units. You end up now producing what is it called? Maybe below what we say you should produce. So that they've already budgeted for, it is a cost to them, and that is why it is what a loss. We'll see a practical illustration to overabsorb. So this will now take us to step 3. Please, I hope you are following. This will take us to step 3. The overabsorption and underabsorption will take us towards step 3. Now, what is this step 3? Let me quickly, this is step 3. Determination of over and under absorption. Determination of over and under absorption. Now, if it is the difference between either over absorption or under absorption, it is the difference between the actual, right, and the overhead absorbed. Class, you cannot compare Moses, right, and Abidemi. Before you can compare Moses and Abidemi, Moses must have what Abidemi has, right? Then Abidemi too will have, if you want to compare both of them, they must have something in common. Class, you cannot just compare actual and budgeted. Actual, budgeted must have element of actual. So if budgeted have element of actual, you cannot say yes, you can compare them now because they have something in common. Class, are you still with me? Are we still together?
Yes, sir.
No. You cannot compare actual and budgeted. Do you know why? You cannot compare. They must have something in common. Budgeted must have element of actual. Then you cannot compare them. You cannot. It's just like you want to compare Moses and Ibrahim. Do we have something in common? We must have something in common before you can say, oh, you want to compare both of us. Class, that is why you will now see that actual fixed production overhead. Can you see it? And overhead absorbed. Your overhead absorption rate that you calculated in step 2 times the actual unit. Can you see now that the budgeted now have elements of actual, because you are multiplying it with actual unit produced. Now, when you now multiply with your actual unit produced, so you can now compare. Yes, you can compare them. That because budgeted have elements of actual. Class, am I communicating, please? Okay. So you cannot say over absorption. How do we determine the over absorption? Let's quickly go back and check. From the explanation that over absorption will be added as gain. Now, over absorption occurs when the absorbed overhead is greater than the actual. Class, when the absorbed overhead is greater than the actual. Now, a practical illustration, you budgeted your actual fixed production, the actual that you eventually, the cost that you eventually incurred maybe is 15 naira. Now, when you now overhead absorption rate, which is your OAR, don't forget that this is the formula for calculating your OAR in step 2, times the actual. Why do we have to multiply by the actual? Is because budgeted, your overhead absorbed, which is your budgeted, must have elements of actual before you can compare them. Now, let's see the overhead absorbed is, let's say if the overhead absorbed is 50, don't forget that if your overhead absorbed is greater than the actual, you have over absorption. Now, you may be looking at it that this is actual. Can you see the actual of 50 naira? Can you see the overhead absorbed? This overhead absorbed is your budgeted overhead. So overhead absorbed is greater. So we still have excess. Thank God. What do? You add it back to what? To the gross profit as over absorption. Right? Though we'll end the class here so that you go and digest it. You go and digest this part of absorption costing. So when we come on when is our next class? Saturday, right? This Saturday? Saturday.
Yes.
Sunday.
Yes.
Sundays.
Sunday.
Sunday. Okay. That's fine.
Sunday by 4:30.
Okay. That 4:30 we'll shift it forward. Maybe we'll communicate. But please understand the logic. One of the major problems of absorption costing is how to determine over and under absorption. Class, go and check YouTube today. They will explain to you, explain. Some will still get confused. Why? Because the practical illustration is that you have Franca, you have Abidemi. You cannot compare Franca and Abidemi because they must have something in common first. Now relate it with actual and budgeted. You cannot compare budgeted with actual without budgeted having the element of actual. That is why you multiply by actual unit produced. Then when the overhead abs, look at it, you budgeted 16 naira as cost. Then you end up incurring 15 naira. Is that not so? you end up having what? 15 naira. Is that also? That is over absorption. When the overhead absorbed, budgeted overhead is higher than the actual. Is that not? So that cost element, that 10 naira that you have, right? It is a gain that will be added to the what? To the gross profit. Now, in another instance, class, where you have actual overhead to be 60, then we have this to be 70. Who will pay for the additional cost? Who will pay for the additional cost? It will be added to expenses. Class, the additional cost will be what? Will be added to the expenses. I'm actually tired. I would have I would have loved to solve an illustration to this, right? Can we do that? This is in 10:15. Oh, 10:15. So now let me quickly complete this. So when you have your over absorption, you had it back, you have your total income, right? Then your expenses, your variable selling expenses, don't forget your variable selling production overhead cost. It is an expenses, variable selling. Maybe you want to sell something and you incur this cost to it. Class, you incur this cost to it, variable selling production overhead. It is an expenses because it is on sales units. So variable selling production overhead times the sales units, you have your expenses. You may have fixed selling overhead. You have your fixed selling overhead, then you're under absorption. In a situation whereby you have under absorption, to be added to your expenses and it will be deducted from your income. So you cannot have either the profit or loss. Don't forget that this variable selling production overhead under the marginal costing, it is non-production cost. But since this is absorption costing is in line with the standard, it's in line with the IS1, right? You can present it for tax purposes. So the variable selling is the expenses you incurred, right, in selling that particular unit. Maybe you want to sell the goods worth 20,000 units, right? You are in VI, then you want to send to Oshodi, right? Then you have to incur a selling expenses. These variable selling expenses could be commission, right? And so on and so forth. Now, class, do we understand the format? Do we get it? Okay.
Yeah, I think we will get the true picture very well by the time we start solving question.
You better get that is where you better get 50% now.
We are getting it.
Just get 50%. So the remaining 50%, I will assume that I've explained it. Is that not so? They will move from there.
Yeah.
So let's quickly 10:18. Let's quickly look at we did not complete. We solved this question under the marginal costing. We're supposed to complete it. We're supposed to use the absorption costing, prepare profit statement using absorption costing. We've done the marginal costing. Excuse me. Now, absorption costing. Right. So what is the requirement? You should not forget, you need to understand the required. We've read it before, right? That is the reason why we just have to move. Prepare profit statement using the absorption costing. We've done the marginal costing. Now is absorption costing. B, reconcile the profit. So we need to reconcile. The reason why you see that the profit of marginal costing will be different from the one of the absorption costing is because of the differences in the valuation of inventory. It is the inventory. Marginal costing uses variable cost. Absorption costing use full costs. Right? Full costs. So class, apologies, right? So in our next class, let's do that in our next class, okay? In our next class, because I don't want to rush it, right? So in our next class, we'll solve the question under the absorption costing. We'll reconcile the profits of absorption with the profit of marginal costing. That is reconciliation. Then marginal absorption costing will take us to activity-based costing. From activity-based costing, we will move to cost volume profit analysis. From cost profit volume analysis to limiting factor. From limiting factor to throughput accounting, from throughput accounting to relevant costing, and so on. We'll move like that, right? But guess what? We'll cover the syllabus. Yes, hopefully we'll cover the syllabus. And if we did not cover, guess what? By the end of maybe September, yes, September. Yes, September. You should know that yes, you should be able to ask yourself question that are you ready for the game or not at the end of September, right? So it is not all about covering the syllabus, but it's all about understanding the topics, right? That is what is most important. So on this note, if you have anyone that have question, quickly unmute your mic before we go. For those who are just joining us for the first time, right? You can check the playlist. Check Next Gen on YouTube. Go to the playlist. You will see PM and MI playlist. See what we have done so far. Is actually there. And if you have someone that is writing maybe management accounting in foundation or cost accounting at ETS, you can share the link with them because they will also do cost estimation, regression analysis, marginal and absorption costing, and so on, right? So you can also share the link. So do we have anyone that have questions? So for those who have actually paid for the material, you know you've been getting your material now, so it's not a problem actually, right? So any question before we go, please? Any question before we go? Thank you. Are we good? Okay, please, your assignment, please. This is your assignment. Please, I'm expecting this assignment. Please. Question. Where is it, sir? Question 3. Marginal absorption constant, right? Question 3. Okay. So, question 3. So please make sure you attempt the question. So thank you so much, everyone, for joining. Feel free to drop your questions.
Sorry,
in
do
the
you have this
platform.
question in
I
our
will definitely
materials?
write it.
Hello, sir.
Yes, it's there now. Have you checked the material?
All right.
Have you checked the material?
Yeah, I
You check it. It's actually
yeah.
is actually there. Yeah, it's there. It's there. So any other question? So we are good. So thank you so much, everyone, for joining, and enjoy the rest of your evening. You can get the question. If you pay for the material, you get the question. I'll send the details to the platform so you can get your material. Thank you. Thank you so much, everyone. Thank you. Bye.
Thank you very much for your time, sir. God bless you. Thank you, everyone.
Yeah.
Thank you.
Thank you.
All right. Thank you. Good night.
Yeah, thank you.
Thank you, sir.
Good night. Rest well.
Yeah, thank you.